For this lesson, I am going to talk about some long-term solvency measures, basically. So for this lesson, I'm going to discuss some long-term solvency measures, some basic financial ratio analysis. So we have three main ratios that we're going to look at in this section. The first one is called the total debt ratio. So let me write that out for you. So our total debt we are going to look at our total assets. That's how much we have. We're going to subtract total equity. And then we're going to divide all of that by our total assets. So this is a total debt ratio. So what this measures and takes into account is all debts of all maturities to all creditors, whether it's short-term or long-term and such. It's going to be all the debts that we owe to their creditors as well. Other item to notice with this total debt ratio is we can kind of change it a little bit and manipulate it to get to a couple other ratios here as well that are commonly used. And one of them is the debt equity ratio. So as a company, so your debt equity ratio is a company wants to know how much debt do we have in comparison to how much equity. So this is going to become very important when you're looking at deciding the optimal capital structure for a company. And at one point, have you maximized all of your debt that you should be taking on as a company as well. So, and then once again, depending on what industry you're in, the company is in, the industries are going to vary, and then the companies within each industry will vary as well. So let's go ahead and take a look at this. So your debt equity ratio is pretty simple as well. We're going to look at our total debt. And we're simply going to divide it by our total equity. And then you're going to obviously get a percentage. You can manipulate this. Another calculation that is used and looked at is the equity multiplier. So let's go ahead and take a look at this as well. Okay, I'm going to just erase this. We're going to start over here. So our equity multiplier. That is our total assets divided by total equity. So it's not the total debt ratio, which is total assets minus total equity divided by total assets. So it does get a little confusing when they're all using the same numbers, like total equity, total debt, that sort of thing. So just make sure, if you need a cheat sheet for all these ratios, just to keep it by your side so that you do not get confused. And so here's the equity multiplier. If you don't have one or two of these numbers, you can kind of use the other number to calculate one of the missing numbers. So if you, for your equity multiplier, your total assets is divided by your total equity. So the second ratio in this long-term ratios group is times interest earned. So it can be abbreviated as TIE. Okay, and this ratio is going to be EBIT divided by interest. And if you want to recall what EBIT is, it's earnings before interest and taxes. And we're going to divide it by the interest as well. Okay, and this ratio measures how well a company has its interest obligations covered. So as corporations and such take on debt, they still have to make interest payments as well. So these creditors want to make sure that they can get their money paid and their interest is paid as well. The third long-term financial ratio is cash coverage. So cash coverage, this ratio is going to be your EBIT plus, I'm kind of going to shorten this, depreciation and amortization. Divided by the interest. So this EBIT can also just be expressed, you can say EBITDA, if you hear that, it's the same thing. So it's EBITDA divided by interest. That is the cash coverage ratio. So it is basically a measure of a firm's ability to generate cash from the operations. It's frequently used as a measure of cash flow that's available to meet their financial obligations.